The silver heist nitrogen monoxide one is talking about a financial story hiding in plain sight for more than a decade. Silver was treated like a joke, ignored by Wall Street, mocked by analysts, suppressed, manipulated, and dismissed as an outdated metal with weak demand and no future. And then, quietly, the people who spent years crushing its price started buying it. Not paper contracts, not ETFs. Physical silver. Real metal. Stored in vaults. That's when this stopped being a market story and became a warning. The bank that rigged the game changed sides. Let's start with something that's not debatable. JPMorgan Chase was caught manipulating silver prices. Not accused, not suspected. Proven. Their traders placed fake sell orders to push prices down, canceled them at the last second, and pocketed the difference. It went on for years. They paid $920 million in fines. Their traders went to prison. That's not conspiracy. That's court record. So when that same bank suddenly becomes the largest physical accumulator of silver in over a decade, you should not assume they changed their mind. Banks don't grow morals. They grow information advantages. December 2024. While everyone was distracted December 22-4, most Americans were focused on holidays, shopping, year-end market recaps, and interest rate debates. Behind the scenes, something unusual happened. JPMorgan quietly moved 47 million ounces of silver into its vault inventory. Not gradually, not over years. In one move, their silver holdings jumped from 12 million ounces to nearly 60 million ounces. The largest single accumulation by a bank since the 2011 silver squeeze. And almost nobody noticed. No CNBC headlines, no Bloomberg alerts, no analyst upgrades, just silence. Here's why that silence matters. If silver demand were truly weak, this wouldn't happen. If silver had no future, banks wouldn't touch it. If prices were fairly set, institutions wouldn't rush to take delivery. But JPMorgan didn't buy paper claims. They didn't buy futures. They didn't buy. They took physical metal and locked it away. When institutions say one thing publicly and do the opposite privately, you follow what they do, not what they say. This wasn't a small bet. It was a supply shock. 47 million ounces of silver is not trivial. That's roughly 6% of global annual mine production. Imagine one bank quietly buying 6% of the world's oil, 6% of global wheat, 6% of copper production. It would dominate headlines. But with silver, nothing. Because silver is small, ignored, and inconvenient for the narrative. And that's exactly why this move matters. The COMEX shell game explained simply here. S. Where most people get lost, so let S make it simple. COMEX warehouses track silver in two categories. Registered silver metal available for delivery against futures contracts. This is what keeps the paper market functioning. Eligible silver metal stored in COMEX vaults, but owned privately. Not for sale, not obligated for delivery. When JPMorgan moved 47 million ounces into eligible inventory, they were effectively saying, "This is ours. It's here, but you can't have it." That's not positioning for selling. That's positioning for scarcity. Why accumulate before telling anyone? Because banks accumulate quietly when they rebuying from people who don't know what's coming. They promote loudly when they want to sell. In 2020, when banks wanted retail chasing gold, headlines were everywhere. Gold hits new highs. Institutions bullish safe haven demand surges in December 2024. Nothing. That tells you everything. While JPMorgan was buying, China was too at the same time, JPMorgan was stacking silver. Something else happened on the other side of the world. China disclosed $8.2 billion in precious metals purchases in Q4 2024. That's a 340% increase from the previous quarter at average silver prices. That could represent over 250 million ounces. And here's the key detail. During the same quarter, China dumped $53 billion in US treasuries. This wasn't diversification. This was rotation. Out of paper promises into hard assets. This is what the dollarization looks like. Countries don't announce currency exits on TV. They do it quietly. Reduce dollar exposure, accumulate tangible reserves, shift away from Western financial instruments. China isn't speculating on silver prices. They're preparing for a different monetary world. And silver, cheap, critical, scarce, sits right in the middle of that transition. The ETF trap. Why prices didn't fall now here is where the story gets impossible to ignore. In November and December 2024, the world's largest silver ETF SLV saw 22 million ounces flow out. That's massive selling pressure. In a normal market, price should fall. It didn't. Silver stayed locked between $30 and $32. Why? Because someone was absorbing every ounce being sold. Not speculators. Not traders. Physical buyers who don't care about short-term price. That's how you spot smart money. This is a wealth transfer in real time. When prices stay stable despite heavy selling, it means weak hands are exiting. Strong hands are accumulating. Paper sellers are giving up claims. Physical buyers are taking possession. That's not bearish. That's foundational. Basel III. The rule change that forces reality. Here's the catalyst most people completely miss. On January 1st, 2025, full Basel III regulations went into effect for US banks. Under the old system, banks could sell massive amounts of unallocated silver, paper, claims without holding the metal under Basel III. That leverage gets penalized. Banks now face capital charges for paper metal positions unless they physically allocate. Translation: either own the silver or pay for pretending you do. JPMorgan didn't wait. They pre-allocated before the rules hit. Every other bank now has to scramble for the same limited supply. And there isn't enough silver. This is where the math gets uncomfortable. Global silver production in 2024. Approximately 822 million ounces. Industrial demand alone. Approximately 654 million ounces. That leaves 168 million ounces before investment demand. Investment demand. Approximately 200 million ounces. That's a structural deficit, meaning inventories must be drained. And they are. Silver isn't easy to produce. Here's another problem. Silver's mostly a byproduct. About 70% of silver comes from mining: copper, zinc, lead, and gold. You can't just mine more silver because the price goes up. And major producers like Mexico, which supplies over 20% of global silver, are openly discussing resource nationalism. Supply is fragile. Demand is accelerating. Inventories are shrinking. That's not a cycle. That's a squeeze. Why this looks worse in 2011. In 2011, silver ran from $26 to nearly $50 in 4 months. Back then, less industrial demand, less institutional participation, lower leverage. Today, paper leverage is more than double. Roughly 250 paper ounces for every real ounce. If even a small percentage of paper holders demand delivery, the system breaks. And delivery demands are already rising. What happens when paper meets reality? When exchanges can't deliver, they have 3 options. 1. Change the rules. 2. Cash settle contracts. 3. Let price explode. None of these are stable. That's why institutions are moving now, not later. The $100 silver question. Is $100 silver guaranteed? No. Is it mathematically plausible? Yes. That's the problem. When even small institutional allocations hit a market this small, price doesn't move gradually. It reprices violently. Silver, IS&T, priced for, Basel III, enforcement, Eastern accumulation, industrial shortages, monetary hedging. That adjustment, DOS&T, happened politely. Final reality check. JPMorgan didn't buy 47 million ounces to make 5%. China didn't buy billions in metals for fun. Institutions don't position early unless the outcome is asymmetric. The biggest mistake retail investors make isn't being wrong. It's waiting for confirmation from sources that only speak after the move is over. This isn't hype. This isn't fear. This is positioning, and the window is narrow.